As requested, today I'm going to be sharing my thoughts on Anfield Energy. This is a tiny um, uranium company with an interesting investment thesis, and I'll hope to cover it today, and I hope you enjoy. So Anfield, like I said, is a tiny company, and it's reminiscent when I was looking at it of one of my favorite speculative investment strategies, which is free lottery tickets, which I may do a video on in the future to explain what I mean by that. But Anfield is similar to Encore in that it's so small, you're paying not much for it, but it all on the same time doesn't have necessarily um, the most exciting assets, but it seems like it would, if they got to a point where they had cash flow, be worth definitely multiples of where it is now. But at the same time, being small, your main risk is dilution. So Anfield's market cap is currently 6.3 million US or 9 million Canadian, which means that it's really not much. Any small money that wants to get into it could make a massive difference, but at the same time, their costs are more draining than percentage-wise than a bigger company. So what type of projects do they have? Well, they have Charlie, which is an ISR uranium project, obviously, and they also have Velvet Wood, which is a conventional one from the report was from a few years ago, which I believe I'll get to it later, but I think it was worth in the 30 something million net present value, 8%. Then they have a bunch of small ones, but even their main projects are not fully de-risked. They don't have the feasibility studies yet, so there's still work to be done. Now, on their Charlie project, it is ISR and it is in Wyoming, which, as I mentioned in the Peninsula video, Wyoming is a can-do state, so that's helpful, but it is colder than other can-do ISR states, which increases potential for costs down the line. Similarly, their next biggest project is the Velvet Wood project, which, as I mentioned before, apparently the NPV 8% from a few years ago when they did their uh, report was 44 million, not 30 something, with a 34% rate of return. I think that's what I was probably thinking of. And that was assuming $65 uranium, meaning that it's potentially could work at 55, but probably would take 60 or $65. So there you have that the projects, the conventional and ISR projects for uranium are worth potentially multiples of the market cap. And then you have what I refer to as the kicker or the free lottery ticket, in that in 2007, Uranium One bought the Shooter Canyon Mill for $90 million, I believe. There is some shares in there and stuff, but I believe it's $90 million. Now, Anfield, whose market cap is $6.3 million, owns that mill. So, what's the big deal about a mill? Well, average US uranium mining ISR or not projects today are pretty cheap. There's a big option amongst the equities out there of what projects you want and not having to pay much for that. Mills are not as abundant, and uranium mills are not only expensive but long in the permitting phase. So, because they have lower supply, one could imagine that they might have higher demand in a bull cycle. Now, my thesis is that in this bull cycle, companies like potentially this one, like Energy Fuels and a few others who have permitted uranium mills will likely command and deserve a premium on the market. Now, here's the thing. I'm not imagining that Uranium One underpaid for the mill in 2007 because It was built in 1980, this particular mill, and it operated for 6 months before shutting down. Now, the interesting thing about that is my guess is stuff like that will happen again, in that by the time mills are permitted and ready to and built and ready to be used, it'll probably be on the back half of the uranium cycle because these things take long. Now, I also don't know how much of a cost restarting the mill would be, which is the big question in the valuing of this company. I do believe, though, I believe I saw an article that said building a new mill of this type would cost $120 million. Now, that being said, that would be a new mill. This is 40 years old now. Although unused, it's probably got some rust in it, so I don't know the cost of restarting. Again, the biggest factor for me in how much this mill might be worth. In conclusion, the deposits here of Charlie and Velvet Wood are probably, if they go into production or if the uranium price rises, um, going to be worth more than they are today. So that might bring the market cap up, and um, you could feel like you're buying that for the uranium upside. Then you have this mill, which is, in my view, a free lottery ticket. It might turn out that it isn't worth much, or that there's permitting issues or something, or it would need to basically be entirely rebuilt in order to be used. But on the flip side, maybe not, because to me, these assets, this group of assets, look cheap today, but could look even cheaper if you get into a bull market when a bunch of companies want to use a uranium mill, but there isn't one. But anyway, that's all I got on Anfield. I hope you enjoyed or found this interesting. Um, but either way, thanks for watching. I'm sorry, I know there's not much here, but this is was requested twice, so I figured I'd get to it, so I could have something to refer to. But it's definitely an interesting case. I'm currently not long it, but it's definitely one to watch, especially at these prices. So until next time, have a good day.